Well, I got news for you, Greg. Your kid is live on Facebook for the Not Your Average Investor Show, Thursday edition, rental income POTW property of the week.
Week.
I am your host, Pablo Gonzalez. With me, as always, the guy that they call GC because he is gracious and he is caring and because his name is Gregg Cohen. Welcome, Greg.
Thank you, buddy. Good to be here with you all. Who's excited to be here for the property of the week on Thursday, right? This is one of the highlights of the week for me and Pablo. I hope it's a highlight for you guys, and we're excited to bring tons of value for everybody here today.
It's a highlight for me too, buddy. This is you got kids. I don't have kids, so I can say this is my favorite.
You can.
Welcome everybody that's chiming into the chat. As you know, if you've been here before, first of all, before I go into my whole diatribe here, we were just talking. Greg's going to have a book coming out. If you've been here for the Not Your Average Investor Show, you've been following along, why don't you let us know in the chat what you think he should title his book? Because Greg's going to need a little bit of help with that. And
like that.
I may run out of creative juice here soon. So, like we like to say, this show, specifically this Thursday show, is all about you. We want you interacting. We want you asking questions as we go through this property breakdown. We want to get into the nitty gritty of rental property investing and the numbers and all that good stuff. So there is two ways to do it. Number one is this chat function that's already blowing up, but there's a little trick to the chat. When you first opt in, that blue box above where you write your text says panelists. If you can hit that, drop it down to panelists and attendees. Now everybody gets to see what you're writing. Matthew Pascalin saying, I want to buy. I don't know. Is that...
I know Matthew. Matthew's one of our longtime clients. Matthew, great to have you here on the show. I haven't seen you here on the show before, so super excited that you're spending some time with us, and we'll certainly have your portfolio manager reach out to you and help you.
Yeah, man. And Matthew, you did it correctly. First time on the show, you're talking to all of us, right? And we also have Leo here. Good morning, good afternoon. We got Rick Margaret and Thomas Chapman. Rick and Thomas, you are going through that right now. You are only speaking to me and Greg. We'd love it if you were speaking to panelists and attendees as well. And that would be wonderful. Also, if you want a question asked by the gracious and caring Gregg Cohen over here, the best thing that you can do is pop open that Q&A box and put it in the Q&A, because as you see, people with great ideas for book names for Greg, like Marilyn that says Life Alongside Pablo. So far, that's my favorite for sure.
This is great.
Chad Willis. Chad Willis only wrote to us, but he wrote The Tortoise and the Hare Real Estate Investor, which is obviously an inside joke about him and Alex Ifakis, the two founders of JWB. We'll go into that right now. But anyways, if you're going to ask a question here for me to ask Greg, please put it in the Q&A. I'm going to try to keep track of it if it's in the chat. But as you see, that moves really, really quickly of everybody making friends. We got an awesome community here and everybody likes to chime in, and we encourage you to chime in. So if you put it in the Q&A, I can keep track of it a little bit better. And that plays well to my limited intellectual capacities and my ways of seeing things. And last but not least, if you are looking for the next step in your rental property investing journey, and this might be your first time, what you want is a breakdown of what the three things you got to nail to get rental properties right for you. And you want this sheet that we're messing around with, the free investor toolkit, go to jwbwebclass.com. Sign up. It's a 20-minute webinar by Greg. He kills it in there. We've edited it down for max value, so it doesn't take up too much of your time, and you get the free investor toolkit. And second, last but not least, if you really just want a personalized conversation, you want somebody to tell you, what's, their best opinion of the best thing for you, tailored to you, go to chatwithjwb.com. Get on the phone with Courtney and the Mikes. They are super, super helpful. I have been through this process myself as an investor, and it's really a great thing to set expectations of what you should be looking for, how things will fit into your portfolio and whatnot. Greg, you ready?
Let's do it, brother.
First, explain the inside joke. Why is the book title by Chad Willis, The Tortoise and the Hare of Real Estate Investing, so
good, Chad?
Gosh darn funny.
So good, Chad. Thank you for that incredible suggestion. I will certainly keep that one in mind. Yeah. So the joke here is, for many of you who have been a part of the show, we interviewed other folks on my team as a part of episodes during the Not Your Average Investor Show over the last year. And one of the episodes is with my business partner, Alex Ifakis. Many of you know Alex, especially if you're here locally. He's in the Business Journal all the time. He's that guy within our business who is figuring out what's next, right? He's got that sexy position in the office of the visionary, of figuring out how to make sure that, we're on the cutting edge and all that good stuff, right? There's some of us in the business that, have to be responsible for keeping the lights on in the business, which, not nearly as sexy, but, fits my skill set. So he and I have been best friends since high school, many, many years now. But we are pretty much two of the most opposite individuals you will find in terms of how to achieve business success, really. And we make this incredible team. So Alex was asked of all of our business partners, I have 3 other business partners, right? So it's me, Alex, and 2 others. And he was asked, well, what are their superpowers, right? As your business partners. And he came up with incredible answers for Adam Regal and Adam Eisman, my 2 other business partners. And then when it came to me, he looked at Pablo and at the camera at me with all sincerity. And I could tell that he had prepared very long and hard for this answer. And he said, Gregg, he's like a tortoise. And I think he meant really well by that. But to me, I don't know, it just didn't seem the same type of superpower that he had relayed to others. So it's instantly become a running joke of me being the tortoise, which actually I think he's pretty insightful, because I am definitely more conservative than my other business partners. I have that role within the 4 of us. And, I love being a tortoise, right? That's who I am. That's fine.
It's true. It's true. You've really bought into that tortoise moniker. The moment he said it, though, you went from like super into this conversation to like,
I was like, really, dude? Really? Like, we prepared for this meeting. You knew it was coming, right? I think we gave him the questions ahead of time.
Yeah,
and that's what you came up with for your boy? All right, man. We'll see how this goes. He knows I have the mic for the rest of the episode. So, I mean, that was playing with fire.
Yeah. And that, I gotta look back to see what episode that was. That was one of our like first 8 episodes, first 4, 4 to 8 episodes. If you want to go back and see that, that was that was back when we were doing things, in person, which was a lot of fun too. We got a couple of other names here. Eddie Harris says, how to co-host a webinar show and make a ton of money in real estate on the side. You're doing pretty good with that, Gregg.
Well, we'll take that. Making money for our clients is always the most important thing.
Aaron O'Neill, GCs of rental properties, Blizzard in Massachusetts.
Oh, yeah. So I know Aaron very well, current client. She's a Patriots fan. And she always talks to me about the Patriots, and I always remind her how cold it is up there and how it's snowing in Massachusetts and why she should spend more time down here in sunny Jacksonville.
All right, man, let's get to some of the questions. We can't just use this all just for sourcing titles for your book. There's a question already. Sean Fletcher asked us here in the chat to the panelists. Sean, if you want to interact with everybody else, I suggest that you change from panelists to panelists and attendees, but that's up to you, buddy. What percentage of vacant properties you manage are client owned versus JWB owned?
Yeah, it's a great question. And I don't have that exact percentage for you right now, but what I can tell you is that we manage about 3,600 homes total, and JWB as a company owns over 300. So call that somewhere around 350 to 400 homes that we own. So you're talking about a very small percentage overall of the homes that we manage being owned by JWB. I think where Sean is probably coming from is wanting to make sure that there's not preferential treatment for our properties that are going vacant given to the company owned properties versus the properties that are not owned by the company. And that is definitely not the case, right? Our leasing team has no clue who owns the property. And even if they did, our success is tied to the success of the couple thousand clients that we have, a lot more than the 350 properties earning, dropping a day on market for those 350 properties would be a dumb move if it caused, worse returns for those 2,000 people that depend on us. So it's certainly not an issue, and it's a very small percentage.
That makes sense. I mean, just to go, I guess that is probably and that's a good question to ask, right? Like we do get some of these questions that are clear that it's trying to get at what properties get preferential treatment. Does anybody get preferential treatment? What is the process for renting out properties? Like, is it the moment it goes vacant, it goes like first in, first out kind of thing, or what is that? What does that move?
Well, we have a system so that once the property becomes vacant, let's say that you own a property with us and have owned it, and then the property goes vacant. We have a system for getting out there within a day to go ahead and do a scope of work to make sure we understand what work needs to be done. We get your approval, we do that work very quickly, and then we put it back onto the market. And then we have a marketing system that is really robust, and every property goes through that exact same marketing system, whether that is the signage that goes out on the property. But what's more impactful is the online marketing that we do. So all of our properties then get syndicated through all of the marketing platforms that we use. And we have sort of the normal marketing platforms that I think most people use: Zillow, HotPads, Trulia. We pay a lot of money to be premier spots on those platforms. In fact, in Florida now, if you're renting a house and you want to put it on Zillow or HotPads or Trulia, you have to pay to do that, which is different than in years in the past. But we've actually been paying for that for a long time. So all clients get the benefit of that. And then we're really big into Facebook for renting homes. We're big into Facebook for doing what we're doing here too, in our Facebook group. But on the renting home side, we do the same thing, probably times 10. Spend a lot of money on behalf of our clients to make sure that we're promoting our properties on Facebook for rent, and every property is treated the same.
Yeah, this is where I come in as a marketing partner and completely gush over your marketing prowess. I remember our first, we had been working together for probably like 3 to 6 months. And you're like, you know what? I think I want to have the whole marketing team come together. And we like put together our little team of, we do the whole show with the repurposing and me and everything else. It's about 4 of us. And then Gregg's like, yeah, let's have the whole team. And it was like 8 of them and 4 of us. And I'm like, oh, whoa. It's like,
it was cool, huh?
Chatbot experts and SEO, that was really cool, man. Yeah. The sophistication of your marketing funnel on the renter side is something that I dream to build up to over here as a content guy, man.
You know, what's really cool about that is we have 4 funnels that are slightly different, but it's 4 businesses really that we run, right? There's the property management client business, who we do property management for clients that don't actually buy through us. Then there's the turnkey rental business, right? And then, meaning what most of you are probably interested in, you buy the rental property from us and complete package. We do the property management services. So there's that funnel. And then there's the rental homes side of the business, which is finding residents for you. And then there's the home buying side of the business. So we do a lot of marketing to find undervalued properties as well. And the really cool thing is that we have high-level teammates in each of those marketing funnels. So they're a little bit different. We get to try certain things out in different funnels and then bring them over to the other funnels. And so some of our funnels are so much farther advanced on Facebook marketing. And then some of our other funnels are so much more advanced on our content, like what we're doing here, right? And we get to kind of learn together and get all these teams together. So I always dig all of the marketing things that we get to do, and really the marketing teammates we get to work with. It's
cool. Just like you have 30,000 data points on homes, you have a ton of data points on marketing because you're spread out across the ecosystem, man. It's really, really fun. Listen, man, true to the impetus of the show, this is about you. So I'm going to continue asking questions. I'll bring up the property as soon as questions are over. Rami Kaura asks, for brand new construction sale, would JWB cover the expenses / mortgage if property is purchased before it's rented out?
Would JWB cover the expenses or the mortgage if the property is purchased before it's rented out? No. So, when clients are brought on board, we tell them that they should expect that it should be cash flow positive from day one. And we are really, really good about that. But the other thing that we want to make sure we share with other folks is that there's no guarantees when it comes to investing in rental properties. And part of that is we want you to be prepared for the fact that at some point as a rental property investor, you are going to experience maintenance cost and vacancy cost. So no, when we go into actually purchasing the home, it's really where we're going to come really confident with you and tell you that you're not going to see vacancy costs right off the bat. But we're also going to share with you that we're not perfect. And we want you to be prepared in that unlikely event that it would happen, that it could happen. So hopefully I kind of gave you both sides of the answer on that one, that I don't expect you to have it, but there's no guarantee if we're going in a technical sense here.
Yeah. And you've talked plenty about like rent guarantees and how it kind of sets up can you go into that? Like the juxtaposition of having a rent guarantee and how that's a bad incentive for your property manager.
Yeah, I wouldn't go as far to say it's a bad incentive, right? A rent guarantee, if I'm thinking about it from the lens of a client, is, it's not a bad thing. But what I think most people do is they put so much of their decision on a guarantee. And what I share with people is that out of all of the decision points that you have when choosing a partner and choosing the right investment for you, a rent guarantee should be near the bottom of the decision-making process for you, because what happens a lot of times is that very small outfits, small companies that don't have a track record, that don't manage lots and lots of properties, that don't have a lot of employees, use rent guarantees as a way to overcome an objection for the potential client. And the harm is that company might not be around in 2 years or 5 years, right? That company probably hasn't been around for, since the last time that the market cycle changed, right? And for you to make this a really wonderful passive investment for you, you need to be investing with somebody who's going to be around for the long haul. So I would just suggest that people keep that near the absolute bottom when it comes to your decision-making criteria. Really, if you work with a company you should be really confident that they're not going to give you a cash flow negative asset right out of the gates. That's what we do, right? We produce cash flow positive assets right out of the gates, and we don't have to rely on guarantees to do it. So that's why we don't.
All right. Love it. That being said, it doesn't happen often, right?
No, it does not happen often.
Like, do you have a sense of like percent? It's probably under 1%. Would you venture to say of times that somebody isn't cash flow positive?
I do not remember I would know. And I do not remember the last time that a brand new client came on, bought properties, and they had a vacancy cost right off the bat. I just don't remember it.
Okay, there you go. Miguel Ducasse. Miguel, you're only chatting to us. If you want everybody else to see it, click panelists and go down to panelists and attendees right above your chat. And man, the questions keep coming. If y'all could put the questions in the Q&A, it would really, really help me instead of in the chat, just for the record. But I'm going to keep going because I'm here to please. Miguel asks, by the way, does JWB manage turnkey property that's 2 to 4 families or more?
Miguel, thanks for the question. Yes, we do manage turnkey or multifamily properties, or even small apartment complexes that are more than just a single unit. So I think one of the largest units that we manage is probably about 20 units or so, a small apartment complex. So yeah, if there's anybody that is looking for property management services and you already own the asset and you're looking for great management like we talk about here, reach out to my team. You can do that by going to chatwithjwb.com and scheduling time, or you can call the office. 904-677-6777 is the number, and be happy to help you.
Okay, great. Jim McMichael asked in the chat, and then he put in the Q&A, so I'm just going to answer it on air. He asked, which Facebook page will this be posted on in case I need to leave early? Jim, this is live right now inside of our Facebook group that you can find by going to jwbfacebookgroup.com. I put that in the chat for anybody that needs it. You can also search JWB Rental Property Investing as a group on Facebook. It then will go, you're going to receive a link to a replay via email as well. It also goes live on our YouTube channel in a week. It also goes live in our podcast in a week. We make this as easy as possible for you to watch the show. So, thanks for tuning in, but trust me, you're going to be able to find this show and all of other shows. You can also go to notyouraverageinvestorshow.com and see all past shows. So that is good self-promotion there. Leo asked for a new client first property, if not rented the next few weeks or month. Is there any help from JWB in mortgages or expenses, et cetera? That kind of feels like that first question. Is there? It is,
but I just want Leo. I know Leo, and I know Leo's property that he has under contract right now. Leo, I don't want you to be concerned at all. If you have any concerns about this, reach out to your portfolio manager. But you're going to be in a really good spot.
Awesome. And Chad Willis asks, what is the average turnover cost once a tenant moves out?
Yeah, so average turnover cost historically is about net to owner is really kind of what I'm quoting here. It's about $2,500 net to owner. So that would mean the amount of money that you need to put into the rental property to put it into great rental shape. And what that is including is you retaining some of the security deposit. So your overall turn costs are going to be higher than that. You less out the security deposit that we're able to retain, and then your net cost to you would be somewhere around $2,500 historically is where we're at.
All right, Greg, it's time to show the property. You ready, buddy?
Let's do it, brother.
All right, you better be ready because this one is a dandy. At 8006 Dandy Avenue. The property of the week is brand new construction, has annual property insurance premiums of only $414, and it generates over a 9.9% estimated return on investment. And that's why it is the rental income property of the week.
Week.
All right, Greg, let's do our usual here, right? So good looking. We're talking here to our friend that's listening in the future on a podcast. So we're going to describe things a little bit, even though everybody that's here can see it. Good looking home, 2-story. There's a garage. What is this? Purchase price of $207,000, 4-bedroom, 2.5 bathroom, 1-car garage. Estimated rent range between $1,400 and $1,450. And the really important stuff, what you're actually buying here, is this: the estimated conventional financing total monthly cash flow of $248 per month. And it has an estimated conventional financing total return on investment of 9.91%. So as we normally do here for anybody that's showing up new to the show, Greg, explain to me, what does that monthly cash flow include and not include?
Absolutely. So a couple of things for a rental property investor. The two most important things you should be paying attention to are, what amount of gross monthly cash flow am I going to receive into my account, into my bank account? And then what is my return on investment going to be? And actually I said gross monthly income, I meant net monthly income. What actually is going to be in your bank account is the first most important thing. So that $248 is what is going to net into your bank account on a normal month. So a normal month as a rental property investor means that the rent comes in, you've got your expenses to pay in the form of principal, interest, property taxes, and insurance costs, and you've got your property management fees. It does not include some very positive things in that number, and it does not include some very negative things in that number, that neither of those happen every single month and don't hit your bank account. So the positive things that it does not include tax savings that you get from the rental properties asset class on your income taxes. And it also does not include principal pay down, which is your resident paying your loan down for you. So your loan balance goes down over time, which is a huge return for you. Also does not include home price appreciation, of course. But that's what a normal month is for this property, right around $250 a month, positive monthly cash flow on that one.
Awesome. And every month you get that $248. We kind of delineated this last time, right? But you're receiving a rent check that goes into your bank account, and you're setting up all your systems to pay off the bills and the mortgage. But you're also getting a phone call from your portfolio manager every single month that makes sure that you're doing what you need to do with that cash flow, right? Something like that.
Yeah, I'll kind of break it down because there's a lot of folks that I guess are a little bit surprised as to how the money actually flows, right? So a common question that we get is, does JWB make my mortgage payment for me? And the answer to that is no. We are not going to take on the liability of making the mortgage payment for you. That's an important liability for you to control. And so what's going to happen is JWB is going to collect your rent for that month. We are then going to subtract out your property management fees. So the 10% that we earn for collecting your rent, plus a lot of other things that we do, that's going to be deducted from that. So if the rent is $1,000 a month, we collect $1,000 a month. We hold back $100 for that month because that's 10% of the rents that are collected. We actually then send $900 to you as an owner in this situation. And then we, of course, have worked with you. We've prepared you so that you have your own bank account that is set up for this process, meaning your rental property investing. You should have your own bank account set up for it, separate from your other your other bank accounts. And then what we recommend is that you set up your bank payment to be on auto pay. And so every month, your bank payment, which would include your principal, interest, taxes, and insurance, automatically gets paid to the bank from that bank account. And then the distribution into your bank account, that $900 coming from JWB, goes into that same bank account. And that's more than the cost of the mortgage payment, plus the taxes and the insurance. And so then that goes out. So it's actually two separate processes. JWB in that example would deposit $900. Your mortgage payment in that example might be $700 or something like that. And then so your net amount in that example that I just randomly made up would be $200. In this property that we're looking at on Dandy, that number is actually $248 for everything I just described there.
It's a nice little nugget, $248 a month. That's a payment for your 16-year-old's Honda Civic, right?
There you go.
If kids these days drive, who knows?
I don't know if they're going to.
All right, Greg, why don't you talk through the ROI then?
Yeah. So cash flow is one part of this equation, incredibly important. You always need to be focused on how hard your money is working for you. And that's what the return on investment calculation is. So return on investment basically takes your net rental income, and it includes all of the negative things that may happen at some point as well, which would include your maintenance cost, your vacancy cost, your tenant placement fees, includes all of those things. It also includes the positive things that happen in various capacities as well. So it includes the tax savings that we talked about. It includes the principal pay down that we talked about. And you take all of that and you divide it by your initial investment. And your initial investment includes your down payment plus your closing costs. So you do all that. That's how you get to this 9.91% return on investment estimated for Dandy. And our goal, based on the current market here in Jacksonville right now and the current lending environment, we can get between 9 to 11% returns for the return on investment. The one thing it does not include, the most impactful profit center over the long haul, does not include is what, Pablo?
The appreciation rate. Why is that, Greg?
Well, so home price appreciation over the long haul tends to repeat itself in your market cycle. Many people do not understand that, but that's really what happens. So what that means is if you go over 10, 15, 20-year segments in your market and in Jacksonville, and you look back and compare that to the historically accurate average home price appreciation, it's going to be pretty close. So if you know that, and you just have to hold on to your properties for a full market cycle, it's almost like knowing the answers to the test, because what will happen is if you hold on for a full market cycle, you will experience roughly that same home price appreciation in the future. If you know that, then that should be evaluated into your decisions. In Jacksonville, the historically accurate home price appreciation rate since 1991 is 4.3% per year on average. You plug that bad boy into that appreciation rate calculation.
I just put in 430%. So that would have been real nice.
That would have been nice, Pablo. That would have been nice.
But listen, 25% ain't too bad either. It's quite a dandy, if I don't mind me saying.
There you go. So yeah, so 4.3%, you plug that in. The theory here is if you buy and hold for a full market cycle, like I suggest to you, then your return on investment each year is going to be a lot higher. That's how you get over 20% returns from rental property investing when you focus on all of the profit centers.
Yeah, and we walk you through this on every single call, right? Because we've had guests in the past, right? Our Tuesday shows an interview show. Just very recently, we had Abe Guerrero, who told us that at first he was kind of getting hoodwinked by other people that were including the appreciation rate in the property estimate. And until he realized that you got to include the appreciation rate because he's a buy and hold investor, that, he realized it was apples to apples. And now like JWB's properties look really, really good. So it's something to keep track of when you are being offered. We of course assume you're looking around the market and looking at other investments. So just, I recommend go to JWB web class, take down this sheet so that you yourself can plug in whatever other numbers you're looking at into this spreadsheet, so that at the end of the day, you can have like a second opinion, right? Like going to a doctor or whatever, right? Would you say that's accurate, Greg?
Yeah, absolutely. It's a great way to compare apples to apples across multiple markets, is to use one way to evaluate all of the profit centers. And that's what this evaluation allows you to do. And so, yeah, everybody can download this for yourselves. It's free. Go to jwbwebclass.com, hang out with me for about 20 minutes, and you get this as a free gift.
All right. And we got a bunch of questions coming in. So I want to get to those right now because they're coming into the chat and they're coming in on the Q&A. And if you could do me a favor and put it into the Q&A, I appreciate it, but I'm still here to serve. So Mike Foster asks, since JWB sells its properties to investors at fair market value, would you say that JWB's bread and butter business proposition for its clients is really its property management service rather than anything particular about the property itself?
I would say largely our value is on the management side. I think when you're investing in rental properties, if you assume that you're working with somebody who's reputable and who can either renovate it well or build new construction, right? That's not that hard to find, right? You'll find other providers out there that will do a good job for the renovation, that will do a good job for a new build if they offer it. But it's really hard to find that same operator who has their goals aligned with you on the management side as well. And the management is what will determine the success of your portfolio long-term. And I'm also assuming that you're choosing the right market, right? People need to choose the right market where you can benefit from all of these profit centers, where you can benefit from positive cash flow and home price appreciation. But you can do that. You could invest with somebody else in Jacksonville and you can do that largely, right? You can do that. You could buy renovated properties from some other outfit in Jacksonville. I'm assuming they do a good job on the renovation. I'm assuming they do a good job on the new build, and you would get largely what JWB does, I would say. But you're not going to find another operation that has the management locked down. And again, my mentality and what I share with all of our clients and all of you is that I think the best way to win in rental properties is to buy and hold for a full market cycle. So when you go in and you make a decision on the partner you're working with, you need to keep that in mind, right? You need to expect to have that relationship for 10 years, 15 years, 20 years. You need to work with somebody who makes more money the longer your residents stay in your home, which is not normal for property management companies. Usually property management companies make more money the shorter amount of time that your resident stays in your home. So to answer Mike's question, I think you hit the nail on the head. The biggest value that we can provide, which is most different than everything else in our competition, in our sphere, in our space here, is the management combined with everything else that we do.
I feel like Mike was just smiling from ear to ear, knowing that he was doing you a favor because you were going to love to answer that question.
Mike and I go back a long way. He's been a client for a long time. And I appreciate that softball, Mike.
Yeah, that's cool. All right. So speaking about property management, Kelly Van Eaton asks, do you upcharge your service calls and parts needed to fix things?
Man, between Mike and Kelly, I'm just getting the best questions to ask. Kelly, thank you so much for asking. This should be a question that everybody asks when you're thinking about hiring a property manager. The simple answer to your question, Kelly, is no. JWB does not mark up your maintenance or your service calls. This is a very common thing in the property management space. Whether it's justified or not, most property management companies charge 10 to maybe 15% as an upcharge on the maintenance item that you get. So one way to quickly understand if your property management company is doing that, obviously I would ask them, but sometimes it doesn't come up in conversation or they don't bring it up. You should ask to see the invoices that your maintenance work required. Most of the time, property management companies create their own invoice and send it to you, and it doesn't necessarily tie up to what the charge was. They mark it up 10 or 15%. So we do not do that. We do not do that because we want your maintenance costs to be low, because that's one of your biggest pain points as a client is going to be, what is your maintenance cost? So we want that to be low. We don't want to make money off of that. The only time you'll see an upcharge for anything maintenance related for JWB is on the property turn. And on the property turn, many times we need to coordinate multiple trades in a very short amount of time, an incredible amount of management to get these things turned in a very short amount of days so we can get it back on the market. So there you will see a management fee for the turn. That's the only one you'll see for JWB.
Kelly's got another question that I think you're going to answer, that you're going to like answering. Do you collect 10% on rent collected or expected?
Yeah, Kelly, you are just asking all the great questions. We only collect management fees on what we collect in rent for you. So another example of our goals being aligned with you as an owner. That is not the way it's always done in property management. You really got to check and see who you're working with and see how they earn fees. Sometimes they earn a set fee no matter what, if the home is rented or not. Not something I would recommend for those out there.
Okay, and now I'm gonna hop around here. By the way, I'm gonna tease something real quick because I'm seeing something happening today that normally doesn't happen. A lot of people are hitting that raise hand button, and I'm getting those notifications. And from experience, I assume that that's a mistake, right? Because every other time that I've been like, "Oh, somebody wants to come on the show," and I'm super pumped up about them to bring them on, they're freaking out. So if you're hitting that raise hand button, just know that we're the way to interact today is the Q&A and the chat. But Tuesday, we're actually having a fan appreciation show. We're actually doing the lessons learned from the last shows of the year. So we're actually going to open up that function, and we want people to raise their hand, and we're going to bring you on screen, and we're going to ask you what your lessons learned are, or what your favorite episode is, or why you're here, like what you've learned in rental income property investing. So letting you know about that. I'm super pumped up about it. It's a new format. I know Gregg's excited as well. I'm going to keep cranking through these questions, and I'm bouncing back and forth now between the chat and the Q&A because there's been a couple of questions in the chat that I'm going to lose if I don't go back to it. But I really do ask if you can put it in the Q&A. It's really going to make me sweat a little bit less. So I'd appreciate that. So here we go. Rami Kara asks, what other ways like private lending, et cetera, are available to invest with JWB?
Private lending is another example of a way to invest with JWB. For those who aren't familiar, private lending is basically where you as an investor become the bank, and you can lend your funds to a developer like JWB. And so we've been doing this for many, many years. Clients lend their money to JWB. It's one of the ways that we're able to build. We built about 300 homes this year. Next year, it'll be about 450, some form of renovation on about 800 homes in 2020. All of that money to do that does not come from the bank of JWB. One of the ways that we need to do this to be able to create this type of scale is we need to have a great source of capital for us. And what that is private lending for, and a lot of that comes from our clients. So private lending basically is where you get a mortgage on the property, a promissory note. You have that security in place. We pay a 10% interest rate, and the term of the loan for you is 3 years. And if you have additional questions on this, I would certainly suggest that you reach out to my team or give us a call. Again, you can go to chatwithjwb.com and set up a time to speak with my team. Or if you just have a question, you want to fire in an email, you can just send an email to info@jwbcompanies.com.
All right, we got our good friend who's back. Anonymous attendee has a question. Where does depreciation come into the calculations?
Depreciation is an incredible tax saving component of rental property investing. Many folks don't understand, or it's a little bit intimidating to understand it from a tax perspective. Anytime you say the word tax, most people just kind of turn their eyes and their ears off a little bit. But it's really one of those things for rental property investors that just kind of sets this asset class apart from others. And when I say depreciation, I'm speaking of it purely from a tax perspective. I'm talking about building depreciation. I am not talking about market value depreciation or appreciation, right? In a market like you're seeing Jacksonville be, where we are a growth market, we have appreciated more than the national average. We are appreciating as a market, but all of our clients who own those properties are still able to take this depreciation tax write-off in that environment. So you want the best of both worlds there. So where is it on the evaluation? Well, that's in our tax savings component. Basically, what we do is we calculate the tax write-off for you for the property that you own. And then we apply an expected tax bracket for you. We choose 30% as the tax bracket for you. And what that calculates for you is the tax savings. And what this means is this is the money that you're saving that you don't have to pay in taxes. Whereas if you invested and earned that same return in another asset class that didn't have these tax savings, you would pay those taxes on it. So that is a part of the return on investment calculation there. And it's a real thing. I really encourage those who might not be thinking about it or might not be considering it. You get even more tax advantages from rental property investing in Jacksonville than you do in other markets because our values in Jacksonville are higher. So your write-offs in Jacksonville are higher than another market like, let's say, Cleveland, where market values are lower. So another thing that tends to swing in the favor of investing in Jacksonville.
Awesome. Gregg, I'm going to keep plowing through these questions, man. This is outstanding participation, folks. Like, we really appreciate this, right? It makes me work harder, but that's what I'm here for, right? So this show is about you. We had other stuff that we were going to cover a little bit today. We'll see if we get to it, right? So
here we go.
Mark Manriquez asks, would financing company for a property purchased out of a solo 401k be different than purchased out of my non-retirement funds?
Great
so
question.
I guess the lender, he's asking if the lender would be different.
Yes. So, and what he's talking about for those who aren't familiar, he's talking about potentially buying properties in his retirement account and getting a loan on that purchase. So if you hear things like solo 401k or 401k or IRA, he's talking about purchasing in one of those entities, which is certainly possible. Many people aren't aware of that, but that's certainly possible. And then he's asking, does the lender change if I was to buy that same property outside of my retirement accounts, meaning just like in your personal bank account, Pablo, just like you're buying your property right now, right? That's correct. That's not in a retirement account. That's from you as a person, right?
Straight cash, homie. Oh, and financing, of course.
Yeah. But the lender that you're using would be a different lender if you were buying in your retirement account. So in retirement account purchases, you have to use a very specific type of lending called non-recourse lending. Non-recourse is required because your retirement accounts do not have a social security number. Your retirement accounts are not something that the bank can go after and ding that credit score if your retirement accounts do not pay the bills. So it's a very different risk structure for a bank. And that's why the vast majority of banks will not offer non-recourse lending. You have to work with a niche provider. We, of course, do. We have a fantastic relationship with our non-recourse lending team. And I'm certainly happy to make that introduction for you. Again, reach out to my team in any of those ways, chat with JWB.com. If you're already a current client, just reach out to your portfolio manager and we can certainly make that introduction as well. But it would definitely be a different relationship than your normal conventional lenders.
I'm going to ask this question that Eddie from Hotlanta asked in the chat a little while ago, and I'm going to get to it now. He says, curious on the ROI for non-recourse financing on this property is 1.59%. I just took the appreciation out, so it reflects those numbers right now, as opposed to the stock market being roughly 8% return. No question mark, Gregg, go.
Yeah. So a couple of things. Let's compare apples to apples. So in the stock market, generally all you're getting for your returns is appreciation, right? So if we're really comparing apples to apples here, right, the cash flow from a stock is, let's call it zero, right? So if we're comparing it and we're taking appreciation off the table, you're looking at it being better than the stock market because most of the time you don't get a dividend in the stock market, right? So that's really the apples to apples comparison. But I think your main point is, hey, listen, 1.59% for a return on investment minus home price appreciation doesn't really get you fired up. Like, why do people do that? And it's a much different comparison, right? So for most people have way too much in the stock market. Their portfolio is too heavy into stocks and bonds and mutual funds. And they feel this desire that they want a different asset class, right? They want a different leg of the stool to make sure that it is something that's stable, so that if something would happen like when coronavirus hit or some major shock to the stock market, that their wealth is not hanging in the balance and doesn't dip 30%, in a matter of 4 trading days like it happened in the stock market. So they want more consistency. Now, the returns over time, if you do include home price appreciation, compare that to the stock market, they're going to be pretty similar, even when you're looking at your non-recourse financing option, right? You throw that in there. It's basically about a 9% return?
Yeah, 9.48% return when you put in appreciation. And at the end of the day, it makes much more sense to me that you would include appreciation when it's non-recourse financing, because you got to wait till you're 65 anyway. So you are going to, if you're investing on 45, you're in for a full market cycle, right?
Well, that's true. I mean, I love your point, which is you're most likely going to be hanging on for a long time. But the other, you can sell that asset in your retirement account in 5 years or 10 years. So it's not like it has to stay in there. But your point is really valid. I mean, the way you're going to go into this is that you're going to want to, obviously invest for the for a full market cycle so that you can count on home price appreciation. So it's more about, number one, it's a better cash flow return than the stock market is one very small reason why people do it. The overall returns for the stock market over the long haul, somewhere 7 to 9% is generally what you'll see over the long haul. We'll call this 9.5%. That's pretty close, right? Your overall returns are about the same. So if the client who does this wants to diversify out of the stock market, and then the other reason is they're faced with a choice of whether to not use financing, basically buy it with cash in their retirement account, or using financing. And for them, it's about maximizing the assets that at some point will be owned free and clear. And so if you have, call it $200,000 in your retirement account, you can make the choice today to buy one asset, not use non-recourse financing, and just own that one asset. And that asset will appreciate over time, and you will have more cash flow today. Or you could make the choice to buy that property using non-recourse financing. And you could turn that into two assets that now have that non-recourse debt on them. You would take a lot less cash flow today than you would if it was owned in cash. But the reality, like you pointed out, Pablo, is that most people don't need that cash flow in their retirement accounts today. For them, it's about making sure it breaks even and then some. And they just want to grow assets in there because they're not going to touch it until they're 60 years old anyways. So at that point, if you made that decision to use non-recourse financing, now you've got two assets that are both owned free and clear in 20 years in your retirement accounts versus just one asset that was owned free and clear in your retirement accounts. And you did that with the same pile of money, that same $200,000 overall. So because you don't need the cash flow today in a retirement account for most people, it makes a lot of sense then to use non-recourse financing in that example.
You know, I've never asked this before, Greg, and I don't know if anybody has, but now that you're explaining all of this, does that mean that if I were to finance it in my non-recourse, I finance it in my retirement account, and I'm having that $208 cash flow while I'm enjoying that 1.45%, ROI and the appreciation eventually. If I'm getting $208 a month cash flow in my retirement account, can my retirement account then be buying, I don't know, Shopify stock with that stuff? Like is that cash flow then able to be invested in the market simultaneously within my retirement account as all that's happening?
Absolutely.
Okay.
Right. That cash flow is
That's
going.
leverage
I
right
want to
there.
make sure that you keep the right reserves.
Yeah.
Right. Let's assume that you have the right reserves, and reserves are even more important for your retirement account purchases than outside of your retirement account. But let's assume that you have done that. Then this $200 a month in cash flow, yeah, that can be spent, invested in other things that are more liquid, have lower barriers to entry, lower, costs to get in, like the stock market. Absolutely.
That just made me really want to do it again. Okay, cool. All right, here we go. Alex Chow has a question. If the property is vacant, does JWB charge the management fee?
It's a simple one there. The answer is no.
Easy peasy. Mark Manriquez, what do you think about the vacation rental market in Jacksonville? Does your property management company work on short-term vacation rentals?
It's interesting. So we do not offer short-term vacation rentals as far as our property management goes. We really stick to what we do best. Vacation rentals has had an incredible year, right? It started off this year, everybody was really high on vacation rentals. Obviously, with what happened with the pandemic, vacation rentals were not allowed for a month. So they really took a dip in value, and a lot of people that invested in vacation rentals were hurt. So I think that you're going to see a lot of vacation rental property deals on the market if you're an active investor out there as that continues to come through, especially as the lack of stimulus money continues to weigh down people's investable capital, and people can hang on less. But overall, we do not do vacation rentals, but it doesn't mean that, I don't like it. I think it's just a more active approach to getting a return, right? For most of our clients, for me personally, I love being passive. I love earning the best risk-adjusted return and signing a long-term lease, 2 and 3 years, and then never having to think about it. And that's what a lot of our clients like. Now, there are some clients that want to earn even a higher rate of return and are willing to put in more hassle and headache to do it. And that's probably where, a vacation rental might make sense for somebody to earn that. I mean, I think generally speaking, if you can get about the same, if you can get people to stay in your homes for 54 months like we do on the long-term side, that is going to equate to probably similar rates of return as what you would get for vacation rentals when you minus out all of the costs. And then if you also put a value on your time for just things changing, variability, right? New residents, new headaches, all that good stuff. I think it would probably net out to about the same, So my preference is obviously passive and short-term. We don't offer short-term vacation rentals for our management as well. But I think that there's certainly a place where others can invest in short-term rentals. And I think there will certainly be some deals to be had there.
Yeah, I feel like short-term rentals are kind of like investing. If you're thinking about your portfolio in the stock market, it's like you got some like blue chip stocks. That's the JWB rental properties. Then you got like the tech sector, kind of that you're like diversifying in high growth stuff. That's property rental. Vacation rentals. It makes sense, right? Like
yeah, and there's a couple other things too, like student housing is one that.
Yeah.
Is similar to me, right? You can get some really great cash flows, some really great returns, not exactly as stable as what we've got here, but yeah, I think there's a place there.
I was just thinking about how much of a pig I was in college. All right. Anyways, Peter asked a question. May I ask, what are the usual complaints of your existing clients? Thank you.
Oh, that's a great question.
It's a tough one.
Yeah. What are the usual complaints? I find that people have a hard time understanding the flow of the money when they first invest in their first rental property. So they have a hard time understanding, like taking this evaluation that we talk about and understanding the grand plan, and then how the money actually hits their bank account for the first few months is not an intuitive thing, right? Like what we lay out here are the big picture of how these returns are going to work. What happens when you come on board as a client, the home gets rented, and really you have costs that are associated with that. So that's actually going to lower your take-home costs, lowering your take-home rent amounts, like your net rental income. That's going to lower that for really the first couple of months. And so I'll kind of lay out a couple of things here. So your tenant placement fee, that's equal to 1 month's rent. Right? Your resident is in there when your home is purchased. And so the first month's rent actually doesn't come to you as a client. JWB keeps the first month's rent as your tenant placement fee. This is normal. Every property management company does this. But it's important for you to know, because the first month you close on the home, you're not going to receive that rent like you thought. There's something else that's going to limit your cash flow coming to you. You've got what's called a maintenance escrow. So a maintenance escrow for us allows us to be able to create this really passive experience for you. And so what we do is we hold back $400, and that fills up what's called your maintenance escrow. And that's the same $400 no matter how many properties you own. If you own 10 properties, your maintenance escrow total is still $400 for your entire portfolio. But we hold that back within the first couple of months of rent being collected. And we do this so that when something very small comes up and we're just going to take care of that for you, you're going to entrust us to act on your behalf. We don't have to call you up every time and say, hey, we've got to spend $25 to rekey the house because something happened, right? We're just going to take care of that. And then we're going to, send the invoice and the bill to you so you have record of it later. And then we're going to talk about it on a monthly phone call with you. So there's $400 that's held back as well. So there's a couple of those items right off the bat that happened. So we started to hear from clients, hey, listen, I thought I was going to be receiving cash flow here and it didn't happen. And there's a couple of months that it takes to sort of even out. Now, I will say on the other side, many times when you close on your loan, you receive a grace period from the bank to where you don't have to make your mortgage payment sometimes for a month to 2 months, right? Because they collect it at closing, and then you have basically 30, 45 days or maybe 60 days before your payment is actually due. So many times that actually kind of evens out. But the flow of money right off the bat is it requires us to make sure we hold hands, especially in the beginning, because I'm a big believer that, as a business, there are a few moments of truth that you get with new clients. where you can either make it or break it. And if you do a really good job and you nail these things, then you're set up for a really great relationship. If you don't, and you miss out on these moments of truth, then you're fighting an uphill battle to regain trust. And sometimes that takes a long time. Well, the first time people need to see money in their bank account, that's one of those moments of truth, right? So what we do to make sure that we do a great job with this is we have weekly phone calls with our clients that are under contract to purchase. And that's all the way through closing. And then as required, we'll continue to do that after closing. At a bare minimum, we're talking to our clients once a month, and we're reviewing the flow of money at least on a monthly basis, and especially in the very beginning for the first few months.
Buddy, I love when you go full transparent, pain point expressing, expectation setting. I think it's what sets you apart. You know, like I really do. I think it would have been easy for you to skirt that one. So I wanna applaud you there. You went hard at what could possibly hurt, and I really like that, man. Thank you.
Cool. I respect that question. That's awesome.
That's a good question. Yeah. All right. Chad Willis asks, how much is the management fee on the tenant turn?
How much is the management fee on the tenant turn? Well, so you're talking about the project management fee. That's 10% of the cost of the turn. So if it's a $3,000 turn, that would be a $300 cost for us to manage that turn for you.
Okay, there you go. Do you have a hard stop today, man? We got a couple more questions here.
I'm good. Let's rock.
Okay, let's keep rocking. Here we go. Leo, welcome back, Leo. Good to have you, man. Do you guys have any property management affiliation that you recommend in Las Vegas? Just checking.
No, Leo, we don't have any recommendations for the Las Vegas market there. Sorry, I can't help you there.
Leo, that might be a good question for the Facebook group, man. You know,
yeah.
Like there's a solid chance out of the 1,900 people we have in there, somebody's got somebody in Vegas.
I like that.
Yeah, but throw it up there, man. And by the way, this is the time we talk about the Facebook group again. Would love to have you. I see a lot of new names here. One of them in particular, Ted Lim, reached out, said he's enjoying himself here for the first time. Ted, it's really great to have you. I encourage anybody that's here on this call, if you like, what we're doing here, we have a community of over 1,900 people. Our goal is to get it to 2,000 by the end of the year. So we'd love to have you join us in the Facebook group. Gregg goes live in there from time to time, but more than anything, it's really become an engaged group of almost 2,000 investors that all give their own experiences. There's a lot of collective group learning that's happening in there. And that was by design, right? Like we are trying to empower community here to help each other out. We're not trying to be the stars of the stage. We're trying to be the stage where people can connect, learn about real estate, learn about investing, get rich as you do it, and have a good life. So Kelly Van Eaton has a question. For those of us who are contract consultants / workers and struggle getting conventional loans, do you have relationships with some lenders that do non-conventional lending at okay rates?
Yes, we absolutely do. I would encourage you to reach out to my team. There's a lot, there are big differences between lenders across the country, between who can actually perform, who can't, between what lending guidelines are. So from a conventional loan perspective, there are many things that can be done to make sure that you qualify. Like, for example, here's one. So there are many lenders out there that don't understand, or their guidelines don't allow them to count rental income as something that is income for you, right? And this would certainly affect you if you own rental properties in their finance, because if you only take the debt service on that, then that's a cost to you. That makes you look worse in the eyes of the bank. But if you're investing in rental properties and you have rental income that offsets that, then that shouldn't be a negative towards your renting ability. And there aren't a lot of lenders that actually allow you to count your rental income when it comes to calculating your debt to income ratio, which is one of the metrics. So, we work with lenders. Of course, we vetted our lenders to make sure that for our product, they understand and their lending guidelines allow to count rental income. Right now, I don't know if that applies to you in your situation, but I would certainly tell you to reach out to my team. And then if it's not something that's going to work conventionally, we do have non-conventional lending products. They're always going to be higher terms, but many times the numbers still work for it to be positive cash flow for you. And so that is certainly an opportunity. And in a worst case scenario, you've got your non-recourse lending option, which is more property-based than lender-based, meaning that no matter what your working situation is, there's a very good chance you would get approved for those because they lend at higher terms and they require a higher down payment, and they're built to make sure that the loan is based on the asset value, not necessarily your ability to finance conventionally. So a lot of options for you. Certainly reach out to the team and we'll see how we can help you out there.
That was super valuable, man. I see a micro content piece of answering that question in your future, Greg.
Zach, please, brother.
Zach Correa, aloha, Zach, says portfolio loans are solid alternatives in the chat. Zach, coming up in a couple weeks on the show, man. Pumped to have you.
Can't wait for Zach to make his appearance. Zach, Pablo and I were talking about having you on the show even before this, and you should have seen Pablo's smile when he's like, Greg, I talked to Zach. He is the coolest dude ever. He's like telling me all about your story. And I don't want to spoil it for everybody, but man, can't wait to have you on the show and learn a little bit more about you. I mean, I know I've known you for a while now, but man, I heard some pretty cool things about your background. Can't wait to share it.
True story, true story. All right, Jim McMichael has a question. Any thoughts or comments on owning just one unit individually versus through an LLC, considering an umbrella policy to cover exposure for tenant liability?
Yeah, and Pablo, you were talking about how this group really is that sense of community and shared learning. This was a very important topic that was just brought up by another client in the group. And so I would encourage all of you to go there and to see all the different viewpoints from really savvy investors out there. This question of how to own your assets is one that has a lot of right answers. A lot of it depends on you. I'm happy to share my perspective as far as helping a lot of clients do it, and then also my personal perspective of how I have done it. When it comes to clients, you can go with the most risk averse way of going about it, or you can go with a risk mitigated approach that actually saves you a lot of time and money and hassle. All right. The most risk averse way to go about it is to buy one house in one LLC. The advantages here is that you have supreme asset protection. The disadvantages is that you're going to spend a few $100s a year maintaining your LLCs and separate accounting and all that good stuff. And you have to spend a lot of time thinking about how to not pierce the corporate veil between, you know, the assets that you have. Like if you do that and you own 5, 10, 15, 20 properties, like many of our clients either do or aspire to do, I mean, that's a lot of management. So I generally don't see that just based on clients. Sort of a middle of the road approach is to buy all of your rental properties in the same LLC, or maybe one LLC for 3 or 5 or 10 properties. I see that sometimes. And there you can still get the financing that you need. There's a way to do that to make sure that you still get the best financing terms. And your costs are mitigated and your headaches are mitigated there, and you still get the asset protection. Might not be 100% of all the asset protection that you would get if you did one per LLC, but it's sort of a middle of the road approach. Or you can go the approach of keeping them in your personal name and then just getting a ton of insurance. And an umbrella policy is a great way to do it. When I first started, that's actually the way that I did it. Because, you know, the way I looked at it is I was okay. I saw the advantages as far as keeping in my personal name for financing. I saw the advantages for ease of use. And then at the end of the day, I'm here to produce the best risk-adjusted return on investment. So I didn't want to pay a few $100s a month, a few $100s a year for extra accounting fees and all that. And the other thing is that I knew that I was going to be buying hundreds of these. So like the idea of putting it into multiple LLCs just didn't work. I kept it in my personal name, became really good friends with my insurance provider, the Ritchie Insurance Group, who still provides insurance for a lot of our clients. And I have more insurance than you can even imagine. That was then. Now, once I got to about 40 properties in my portfolio between my business partners and I, we then put it over into an LLC. And, you know, since then, of course, now I've been doing it for 15 years. Our properties are in various LLCs, and it's quite a complicated structure for us. Doesn't have to be that complicated for you though. So, you know, I would think, you know, just weigh the priorities for you and your family and what's most important to you. If you are completely risk averse on this, maybe buying one per property or one LLC per property might be the approach. If you're like most people, it's somewhere in the middle, either going in your personal name with a ton of insurance, or, you know, a certain number of properties per LLC is something that is also pretty common.
Okay, so quick clarification question here in the chat from Ted Lim. He said, do you suggest forming the LLC first before buying the investment property? Sounds like that's like a either or question. It's kind of like up to you there. Or?
Well, I would first talk with, let's say, my team or whoever you're working with to understand what your strategy is. Make sure you know what your strategy is. It doesn't mean that you have to form the LLC before you purchase, because when it gets to financing, you're going to want to keep the property in your personal name. Even if your plan eventually is to put it into an LLC, you're going to want to keep it in your personal name because banks won't make loans. Conventional lenders won't lend to an LLC. So there's a process for taking it from your personal name to putting it into an LLC. There's a lot to talk about there. Don't have enough time on the show to do it. But to get to your question, do you need to do one before the other? I would say have a plan in place. Doesn't mean you have to have the LLC formed before you buy the property. You can do that even after you purchase the property. It's pretty easy to create an LLC.
All right. Mike Foster dropping value in here. He says, this is a comment, not a question. You had a guest on a couple of weeks ago who mentioned that when a property bought outside of an IRA or 401k is held until death and passed on to an heir, we were talking about Ken Moline here. Yeah. Then when that heir eventually sells, he or she is not subject to depreciation recapture. I verified after the show that he was correct. That's a huge benefit for buying and holding an investing property until the end of your life.
That is huge. When Ken was talking about that, in my mind, I'm like, man, I've never asked that question. I've never checked that out. Obviously, I'm not at that point in my life, hopefully, or anywhere close. But I'm like, man, if that's real, that is really important. A big question that you get, especially for those who are kind of near retirement or thinking about what their legacy is, why go to rental properties versus stock market, right? People may feel like it's more messy to be in rental properties with your estate. And so people are searching for reasons as to why there's a huge value for rental properties versus the stock market. And in addition to consistency, that one right there is huge, not having to pay those taxes on the depreciation recapture. So thanks for bringing that up, Mike. I think that is really, really important.
It's funny, man. Yesterday I was scheduling our social media posts from that episode, and we purposely pulled that piece out because you see your brain explode in the middle of the show. And yeah, man, it was good to see you're like, whoa. Anyways, yeah, it'll soon to be seen on the Not Your Average Investor Show YouTube channels. All right, Chad Willis says, if I purchase a home outside of an IRA account today, then want to put it into the IRA in the future, how does that work? Or do I need to make that decision at the time of purchase?
Yeah, I can't do that. You can't sell a property from yourself personally into your own retirement account. So not going to be able to do that. So yes, you would want to set that up correctly from the very get-go, whether that is going to be in your retirement account or not.
Mark Manriquez with an awesome question, because we were supposed to talk about this about an hour and 15 minutes ago, but we've had so many good questions. He asks, is hurricane insurance required? Do you use concrete block construction or any other hurricane resilient materials? I'm going to share the screen right now.
Absolutely. Great questions there. So insurance costs are one of the huge advantages to buying new construction properties. They are really, really low. So for this property here on Dandy, it's $414 a year for the annual insurance premium. That includes hurricane protection, which is really kind of wind protection is what really it is from an insurance perspective. So that is required in the state of Florida, and that definitely is included there. I think the other the question was about concrete block. We do not build with concrete block, or did I miss something there, Pablo?
Yeah, he said, is it required? And do you build with concrete block, or do you do any other mitigating stuff?
Do a lot of mitigating stuff. I mean, the mitigating stuff is required by the building codes at this point. In Jacksonville, a lot of your homes are built with wood frame construction. That's the way our homes are built. It would be incredibly rare to see a concrete block home built in the neighborhoods that we build. And so ours are wood frame. We don't build with concrete block.
Yeah. And so I actually know a little bit of history on that whole equation, because I used to be a green building expert in my past life. After 1993, when Hurricane Andrew demolished Miami while I was just a young pup there. And the state of Florida has really, really upped the requirement for wind mitigation built into the codes of construction, right? So like they spent about 5-6 years kind of iterating through trying to figure out how to like really reduce the risk of hurricane damage in a home based on building codes. And once they figured that out, then they started focusing on energy efficiency. So little trivia for that. Little trivia
Absolutely.
for you there.
Hey, do you know the last year that Jacksonville was hit by a hurricane had a direct hit?
Does Irma count?
Nope.
That wasn't a direct hit. That was just flooding from Irma. No, what was it?
1964.
Yeah.
Hurricane Dora. That's the only time Jacksonville has actually had a direct hit. So for those who aren't familiar with Jacksonville, we're in the northeast part of the state, very different than the susceptibility that our friends in the southern part of the state feel, or really anywhere else in the state, to be quite honest, because sort of how the winds go and where we are in the northeast part of the state, usually don't get a direct hit. And something, I was on a webinar with a friend a couple of weeks ago, and he goes, "Hey, Greg," he goes, "Did you know that Jacksonville's never had a direct hit?" Or I'm sorry, let me get this right. Jacksonville's never been hit by a major hurricane. And I was like, really? Yeah. So they define major hurricanes as category 3 or above. Actually never, ever been hit, which Paulo, you and I were talking with Kate on our marketing team earlier. And she's like, I really don't want you to say that, because that would not be great if that happened because you opened your mouth. But, I said, Kate, we're gonna let the chips fall where they may. So, but that's actually true. We've never had a category 3 hit us, and haven't had a direct hit since 1964. And I believe that was either a category, I don't know if that was a category 1 or a category 2, but a lot of protections in place from just kind of geographically where we are as well.
Yeah, those are the same geographic things that make Jacksonville a really great place for surfing, right? Because there's these like light offshore winds that happen. We're in this like nook below Georgia, above Florida, and it's kind of like a weird ecosystem that creates what I came here for. That's for sure. So, all right, there's a couple comments here in the Q&A that I think were just comments based on prior discussion. Jackie Hung says, deed the property to a land trust and make beneficiary to LLC, 1 land trust per property.
I've done that. It's going to make you pull your hair out. I've done all that stuff. It can be done. And you're right, Jackie, but between insurance and lending, and then just people just understanding, even in your own office, which entity owns what, it created more hassle for us than we found benefit for it. So, but it may work on a smaller scale.
Awesome. Mark Manriquez puts here in the Q&A. Mark, this is awesome. Thank you both. Great show. I am new to your company and look forward to learning more and speaking with your team. Mark, that means go to chatwithjwb.com, set up the call. You're going to have just as good of a time talking to Courtney and the mics, maybe. We'll see, but we do want you hanging around. Miguel Angel Sanudo asks, is JWB thinking on operating in a different city?
Great question, Miguel. No, we are not thinking about operating in a different city. We are committed to Jacksonville, and that's a very different message than you hear from other turnkey providers out there, because many are searching for inventory, but we believe that we can have the most positive impact on our community, for our clients, for our team, for us personally, here in Jacksonville, and really go a mile deep rather than a mile wide. And we have enough inventory to make sure that our clients are taken care of. So we're going to be here.
Yeah. And if you tune into past episodes, you know that JWB is looking like 30 years down the line. They're pushing things. We actually had an episode all about profit centers outside of the property line, right? Like all the stuff that JWB is really like pushing in downtown, getting involved in the community, that actually, the tide that raises all the boats. And to me, that is a major differentiator of why I decided to do, business with you guys, right? The idea that we're having a baby, like we're here forever.
There you go. I feel like that's a great piece of social content right there.
Yeah. No comments. All right. Miguel Angel has another question. How does JWB decide what maintenance costs correspond to the owner or to the tenant because of bad care?
Well, this is something that's explained to the resident when they move in. It's clearly explained for the items that are their responsibility, that, if they break it, then they're going to be required to pay for it. There are a lot of items that would fall under wear and tear, general wear and tear for a unit. And that's not something that you can go back to your resident and require them to pay. You can't hold back the security deposit for items that fall under general wear and tear. And our property management team knows all of the details on exactly what the definition of what would be. There's no better source than a team that has managed literally 3,600 homes year in, year out, collected rent and dealt with maintenance issues on 3,600 homes, and can really kind of share all of the lessons learned and prepare you. So Miguel, I know you're a current client, and if you have specific questions, please reach out to your portfolio manager, and we'll be happy to give you any more clarity that you need on that.
All right. Rick Margwin asks, have you set up RLT? I imagine that's Real Living Trust or something like that. And are you able to add properties to it as you do?
A revocable living trust,
Revocable living trust.
Yeah. No, I have trust for myself personally. And I'm wondering, I'm not a trust expert, so I should probably start there. So everything we have in the company is held in the company as far as our rental properties between my business partners and I. So not a real avenue for me to put those into revocable living trusts. What I would really recommend is reaching out to the group. I know Al Nicoletti was a guest on our show. We specifically talked a lot about trust and how that can work for your benefit. So I would suggest going in the group. I know Al is there, and if you posted a question about that, I'm sure Al would respond. And I'll if Al doesn't even see it, I'll hit Al up and I'll ask him to respond for you. So I'd say just go to the group and we'll get that answer for you.
You may not be a trust expert, Greg, but I don't know what it is about you. It makes me want to trust you all the time.
Buddy, I feel a real sense of, appreciation coming from you today, brother.
I'm in a great mood today, man. I don't know what it is. Like, listen, dude, the chat's been on fire. Like, we have a bunch of new people. This has been fun, man. Like, I love Thursdays. Yeah, Zach, love fest indeed, bro.
Do you remember when we started this on Thursdays? We're like, how are we going to fill an hour of talking about? You realize today we haven't even talked about the property at all.
We barely talked. I know.
What a very cool thing for all of you out there. I appreciate you.
Is that property available, Greg? Or is this one of these ones that was available 2 days ago and now you're gone?
This one's available. This year on Dandy is available. So for those who, I know we talked about a high level, but, for those who are interested in it, reach out to the team, chat with JWB.com or call the office. And if for some reason it gets picked up, and the greatest thing is that whether or not this one's available or not, there are literally dozens right behind it that you can add to your portfolio. We do the same thing over and over and over again. So it's more about if you believe in the model, if the investment makes sense for this asset, reach out to the team. We'll get you set up, and we can add this one to your portfolio as well.
Okay. Sean Fletcher has a question that I know you'd like to answer. How often does JWB inspect/visit properties under management? Is it annual?
So we don't have a set inspection schedule. This is something that for many years we actually did. And, many times we're going to, do things that may be unconventional in pursuit of driving better returns for you or aligning resources for you so that we can ultimately drive the best risk-adjusted return. We've done this a few times, but every time that we do something, we're always going to test it out with our own properties in advance. And so when it came to inspections, many years ago, we heard from another company that we respect greatly in the space that, they said that they stopped inspecting properties on an annual basis. It became more of an inspection, kind of like a need-based inspection. And they also basically made sure that, like us, they were in the neighborhoods all the time, and they were very proactive about going into the house if something kind of ticked the box that we needed to get some eyes on it. So that's sort of the approach that they had. And we said, I wonder what that would do to long-term costs. I wonder if that would increase your property turn cost. That was our biggest question mark. If that would increase your overall maintenance cost if you didn't lay eyes on it. And they're like, nope, we tested it out. We've tried it out. We've been doing this way for years, and it has not raised property turn costs. And we said, I don't know about that. So what we did is we actually used our own portfolio, over 300 properties, and for an entire year, we did not do an annual inspection just on our properties. We also, at the same time, used all the other properties that we manage and continue to do annual inspections on those. And then after the year was over, we looked and we compared what were the average maintenance costs and what were the property turn costs specifically. Were they higher in our own properties? We didn't see a difference at all. They were the same. And so at that point, we realized that we were doing this and that we could use these resources to lower your return on investment in other places. So when we realized this, we stopped doing set annual inspections. Another thing to think about is, how much of an inspection do you really get for a resident who is expecting it? And, how much are you just doing it for FaceTime, really, or for something that might not actually be impactful for you as a client? So we changed those resources. We then put those resources to other places like available homes, right? We built out this model where we can rent your homes without actually being there and actually letting residents in place, which proved to be incredibly important as we went into the coronavirus pandemic. And in order to do that, we need to make sure that since we're not letting people into these homes, we need to make sure that we're in these homes on a routine basis. So we have a team member in our office, a salaried team member whose job is to go and inspect available homes to make sure that when that resident goes and inspects it themselves in self-assisted showings, that they're going to find a home that smells good, that looks good, that doesn't have bugs and the walkway because people just trounce through it. So we really reassign those resources, put it to a number of places that we're going to lower either days on market or lower costs in other ways. And so that's what we did. So short answer to your question is no, we don't have set annual inspections. And this is proven to be the best use of resources for everybody.
There you go. I love it, man. And I love the idea that you guys are like the Game of Thrones fans out here, the Lord Varys, where you have all your little birds around, right? Like you have like the contractors, like since you own a bajillion homes in the neighborhood, you have contractors working on stuff. If you see something funny going on, you tell them to go check it out. Like I love the organic network of feedback that you guys have built out. Like I picture it like like Big Brother.
It's become easier over the years. I can tell you that. In the beginning, it probably wouldn't have been possible because we didn't have that sort of reach or the vendor relationships that we have or the number of homes under management. But now we're there all day, every day. That's
cool, man. Marilyn Cotterman asks, what is the down payment needed on this home? So I'm going to pop in here for the conventional financing tab. By the way, this is a spreadsheet anybody can download at jwbwebclass.com. Not with this property, but you get the formula.
There you go. So what you're seeing there is the financing assumptions, just like Pablo's mentioning. This is the evaluation that you guys could change the numbers on this. That's why this is such an important tool for you to use no matter what market you're thinking about investing in. It's all applicable to be changed. So if you're assuming that you're putting 25% down, your down payment amount here would be $51,750. On top of that, you would have estimated closing costs. And if you want to go to the right there a little bit there, Pablo, that would mean that your total initial investment would be about $56,925, assuming that you're putting 25% down. Also, we'll share with you that many clients put 20% down. So if you want to change that up, Pablo, gosh, so money. So that limits your out of pocket by putting 20% down here, including your closing costs, to $46,575. So, and what that also does is it increases your return on investment if you put less money down. So somewhere between, call it 46 to, what was the first number, 50?
Hold on. Let's look at the return on investment when you put down 20%, Greg.
There you go.
You want to prove you're right here. It went up to 30.34 with appreciation, without appreciation. What do we got? 11.23. Not too shabby.
Can I throw one wrench in there? Because I always go like way into the details and I want to show every side of it.
Of course.
So if you're putting 20% down, you're going to see a slightly higher interest rate on your loan. So one of the reasons people put 25% down is because they'll see a slight decrease. So I don't exactly know what the rates are right now, but let's just say that there was, 1.25% higher for 20% down. Go put 4.125.
Okay. Did we mention the fact that cash flow goes down?
Yeah.
Cash flow. Yeah. We did mention it?
No, we didn't do that, but that's a really good point.
Yeah. So cash flow goes down a little bit. ROI goes up. Let's go to where's the rate here? Where's the rate?
H7.
Help me out. Where's the interest rate that I got to put in?
Yeah. H7.
You were helping me out. I just talked too much. What am I putting? 4.1?
4.125.
By the way, I would like to say that I just got approved for a loan for my property that I'm investing in at 20%. And it was what, 3.63?
Yeah.
Not too shabby.
Yeah, that's pretty awesome. Obviously, it can vary depending on how nice of a guy you are sometimes. So, I mean, that's why you got the Pablo rate, I guess.
It works almost every time. All right. So 4.13%, where are we headed?
So now what we're doing is really, in this case, comparing apples to apples. We're putting 20% down with a slightly higher increase in the rate versus 25% down. And so you can see slightly higher rate gives you that 10.78% return, right? Now, if you put 25% down, but you had a lower rate, your returns overall are still lower, right? So this proves that point that lower money down, even though it will give you less cash flow because you have more of a monthly payment to make, less down into the deal usually is a better return on investment, and definitely with what you see here, even if there's a slight rate increase. There
you go. I gotta stop the show real quick and say what Rick Margwin here just put in the chat. This may be the high point of my life here. Not the chat, in the Q&A. He puts, FYI, Pablo, you're a rock star. You pronounce my name correct every time.
Oh man, you know what? Did you pay Rick to say that? Because you butcher everybody else's names.
I would pay him. I'm capable of such things. Rick, let me know what your Venmo account is. I'm in.
That's incredible.
That's awesome. Seriously, made my day, because I butcher a lot of names, Rick. So here's a name I won't butcher because I speak Spanish. Miguel Angel Sanudo asks, why did you stop making videos of the properties? It was a really good way to virtually visit it.
I don't think we did. We've been doing it every Friday.
Oh, videos of the properties?
Okay, so not the walk and talks?
Yeah. No, I guess virtual walkthroughs is probably what he was talking about.
Gotcha. You know, I'm not sure if we do that anymore or not. What we've really gone to is the 3D tours, Miguel, which is basically the same thing, except it's just a lot easier and a lot more user friendly for everybody. So I'm not sure if we have stopped that. Now that you mention it, I do think we stopped that, but the 3D tours are better. So if you don't have access to your 3D tours, let my team know. And I think you'll find those are probably better than the shaky videos that you get sometimes of construction guys walking around doing video walkthroughs.
Awesome, man. Rick, I love you, man. He puts just keep doing what you're doing is enough payment for me. All right, I'm gonna have a love fest with Rick here. Greg, don't get jealous. All right, man. We're coming up on 2:00. I think we got to call it, right?
I think so.
We got to get you going. Last question from Marilyn Cotterman. What's your book about?
You know, that's a really great question. I'm trying not to go in with some preconceived notions. Working with a really high level team to help me present this book in the right format. And I just signed the contract yesterday, so I haven't had any of those discussions yet. So, but I would love to, have your all's help with this throughout the process. I think one of the cool things now is we have this platform, and you guys give such great feedback that if I really want to make this book impactful for others, there's no better source of feedback than you all. So, as we're going through the process, I'd love to ask for your help, and I'll certainly keep you in the loop, and I'll probably have a lot more information, a month from now than I do right now.
Yeah, buddy, I can't wait for you to go through the process. And speaking of feedback, next week, the show is literally about you. Join us, right? We're like Greg and I are going to talk about our famous moments, our favorite moments, best takeaways from the show. But we want you, the Not Your Average Investor family, to be part of the show next week. We're going to be taking people, joining you in on the call, figuring out what your favorite moment is. I'm talking to you, Bill Shields, that comes all the time. Talking to you, Dominic Albano. I've seen you a bunch. Jackie Hung, I've seen you plenty. John Henning, right? Like Ken Moline, of course. Leo, right? Like we want to call people into the show. So next week, join us on Tuesday. Have your be camera ready because we want you to raise your hand. We're going to bring you on and just we want to hear what you've learned, right? Like what we're doing right, what we're doing wrong, whatever your best takeaway is, right? We want to really crowd like get the wisdom of the crowd. We're just two people here, but this is a community, right? So we want to like have you on board. We're wrapping up year one. This has been an unbelievable journey. I have learned so much. I've become great friends with Gregg to the point where, like we barely knew each other before, man. It's awesome.
We did.
And yeah, that's it. Listen, without anything else, go to jwbwebclass.com, get this form, use it for your own benefit, spend 20 more minutes with Gregg. Go to chatwithjwb.com when you're ready to take the next step. Marilyn Cotterman says, love this community. We love you, Marilyn Cotterman. You've been an integral part of the community. I hope that you raise your hand next week so we can get you on and talk about the manatees of Homosassa. And that's it, Gregg. I'll leave it up to you. We had 50 people on today. We had 40 plus for over an hour, into an hour and a half. This is unreal to me, man. I'll let you take it away. I'm so grateful.
I mean, I think Bill Shields summed it up exactly right. 90 minutes, you guys are out of control. Thanks again, right? I mean, that's really what this is. This has become such a fun time for Pablo and I hope you guys are enjoying it as much as we are. I think you are, because most of you are still here after 90 minutes, and it's just never lost on us. Just the simple act of taking, call it an hour out of your day, or maybe even 90 minutes out of your day on Tuesday and Thursday to hang out with us. It just means a tremendous amount to Pablo and myself. And so we appreciate you. We're going to keep trying to bring as much value as possible, and really excited about next Tuesday's show and showcasing a lot of you, the community out there.
Yeah. And Leo, I'm going to leave it with this. Thanks, guys. Leo puts, thanks, guys. Great show as usual. Title of the book, Property of the Week.
That was so good.
All right. See you next week.
See you, everybody.
Bye.